Then let's practice the purchase budget and cash disbursement. In the same way as the sales and collection budget, the purchase amount of the month is not the same as cash disbursement due to the credit purchase and deferred payment. And we need to remember the the calculations. The beginning inventory plus inventory purchase minus budgeted the cost of goods sold, and then ending inventory. We'll apply this simple equation into the budget inventory. Here, the beginning inventory plus inventory purchase minus now the budgeted cost of goods sold is equal to desired ending inventory. And then we take this budgeted the cost of goods sold and the beginning inventory the other side, then the inventory purchases, the budgeted inventory purchase is equal to this desired ending inventory plus the budgeted cost of goods sold and minus beginning inventory. And then we'll use this budgeted purchase to budget cash disbursement. Let's go to the Excel exercise. This is the example of a purchase and the payment budget. The green lighting supply plans inventory level and cost at the end of each month as follows. That is ending inventory information. 271,000 in May, 226,000 in June, 209,000 in July, 241,000 in August. And we need the sales expectation because based on this sales in each month, the forecasted sales will calculate the ending and cost of goods sold as well. And then the purchase in April, also the given in April 258,000 and in May 188,000. And each month purchase are made as follow: 50% during that month and 70% the next month, and the final the 50% of the next month. The final of the next month. I think that it should be next month. Okay, the forecasted sales on June. Let's collect that information indicated in the question. So 449,000 and 359,000. Then in August 306,000. The forecasted ending inventory desired. It is a given number set by the corporation. 226,000 and 209,000, then 241,000. Then the reason why we are doing this data input section is that we don't want to read this question once again. So we collect this and then reorganize this information into the data input section. Cost of goods sold percentage of sales we are going to use is 65%. From here, cost of goods sold 65% of sales, and then ending inventory in May. How much is the ending inventory in May? Ending inventory in May 200. There you go. 271,000. So in May 271,000. Then purchase inventory in April. How much is that? Here we go. Purchase inventory 258,000. And then in May 188,000. Purchase paid for as follows. Here the current month 15% and 70% and then 15% as indicated in the question. Now let's start how to create a purchase budget. A little bit complicated. We need to go step by step. So cost of goods sold, as indicated in the question, cost of goods sold is 65%. 65% of sales. So the cost of goods sold. Because we can assume we can get the estimation based on the past cost of goods sold percentage in the income statement or you can use some gross profit margin percentage from the past data. It's not much different from the past the experience. So 65% is the percentage of current sales. We are going to use this input times 65%, which is fixed. So we will drag like this, and then we get this cost of goods sold budgeted plus desired ending inventory. Where is the desired ending inventory? Here we go. We already collected. Then let's drag. Next, total need. Now the total needs, I'm going to just clarify this. Total need inventory is this as a sum of these two. So that is total need inventory. Why it is the total needs inventory? Because the company want to remain on hand this desired and the inventory, and they want to sell by this amount. That's why that is the inventory need. Then less beginning inventory, the last month, the beginning inventory. So what is the beginning inventory, June? The ending inventory. That's correct. That is the ending inventory in May. Then from July now, you may already notice that. Now, right, that is June. The June desired ending inventory is the beginning inventory of July. The same way, the beginning inventory of August is the ending inventory of July. So 209,000 should be here. And then now the calculation is total need inventory, the cost of goods sold plus the desired ending inventory minus the beginning inventory is now we have the purchased inventory budgeted. We need to purchase this inventory by this amount. Now we got it. So 246,850. In the same way, we got the budgeted the inventory purchase. Now, the disbursement for purchase is different because as our customers purchase our goods on credit, then they pay us deferred. In the same way, we also the company also pay their purchase not right away, but next month, even next month. So it is different. So this purchase inventory would be different from this total disbursements for a purchase in each month. We will compare these two. Okay. Now the 15% of this month's the purchase. Again, how to get it? Right, this purchase inventory, out of this we pay only 50% cash, so 37,028. The same way the months. 70% of the last month purchase. 70%. Then where do we get it? Where can we get the last month purchase? There we go. Here the first month after purchase. Oh, the May, we have May information, 70%. Now we will use 70% times the May, 188. That is the last month. So 131,600. Then next, July, the 70% of the last month purchase. Now we can use when was the last month? Right, the June for the July. So the 70% of the last month's purchase. So we will use this times, that's correct, 70%. Oh, sorry, in a different place. Here we'll use this last month's purchase inventory times 70%. So 172,795. In the same way, 70% times now the last month will pay next month. And then 50% of the second last month's purchase. In the same way, now we have April information from June, that is 2 months ago. 258,000 times, where is the percentage? Okay, 50%, so that we pay all. So 38,700. What about July? July 15%. Where do you get it? When is the month? 2 months ago from July. Okay, here we go. The May times 50%. So 28,200 is the 50% of purchase from this May. Then August. Now 50% of what? Right. We use this June because that was 2 months ago from August times 50%. Then we finish it. That is all the cash collections from this month, last month, the second last month. Then we just sum up this 3. Then got it. So that's how we create a disbursement schedule for purchase. As you can see, this purchase inventory is purchased amount of inventory is not the same as this disbursements for purchase. So we need to build up this cash disbursement schedule. That is the actual cash out. Okay, see you in the next video clip. Bye bye.